Welcome to StokTok's deep dive into L'Oreal. L'Oreal is the world's largest cosmetics and beauty company, operating across professional products, consumer beauty brands, and luxury fragrances and skincare. The company generates revenue from millions of salons, retailers, and direct-to-consumer channels across more than 190 countries. As of May 8, the stock is trading at $85.21, positioning it near the middle of its 52-week range, which spans from $78.82 to $95.48. Let's work through the fundamentals, scene by scene, starting with a quick business overview. L'Oreal operates through a diversified portfolio spanning professional haircare, mass-market cosmetics, luxury skincare, and premium fragrances. The company's competitive moat rests on brand equity. Iconic properties like Lancôme, Giorgio Armani Beauty, and Maybelline command pricing power and customer loyalty across price points. Distribution density is another strength. L'Oreal reaches consumers through prestige department stores, drugstores, salons, and owned e-commerce platforms, creating switching costs and network effects that competitors struggle to replicate. The company has demonstrated consistent pricing power and geographic diversification, which reduces exposure to any single market. Our StokTok score on L'Oreal is 38 out of 100, a caution signal. The score reflects stretched valuation, modest growth, weak institutional positioning, but solid profitability and financial health. Let's examine each dimension in detail. Now, valuation. The question every investor has to answer: are you paying the right price? L'Oreal trades at a trailing 12-month price-to-earnings ratio of 31.82 times, which is elevated relative to the broader consumer defensive sector. The forward price-to-earnings multiple, a forward-looking estimate of earnings, sits at 26.08 times, suggesting some moderation in valuations as earnings grow. However, the price-to-earnings growth ratio, or PEG, stands at 2.68. For context, a PEG below 1 generally signals that valuation is reasonable relative to expected growth. Above 2 suggests investors are pricing in growth that may not materialize. The enterprise value to EBITDA multiple, that's the company's total value including debt divided by earnings before interest, tax, depreciation, and amortization, is 18.53 times, which is also in the premium range for mature consumer companies. The price-to-sales ratio of 4.27 times reflects the market's willingness to pay a significant multiple of revenue, suggesting high expectations for margins and returns. Our DCF, or discounted cash flow model, indicates the stock is trading at a 78% premium to intrinsic value, meaning current price substantially exceeds our calculation of what the business is fundamentally worth. Wall Street analysts tracking L'Oreal have a consensus mean price target of $96, with a high target of $103 and a low of $88, based on 3 analyst estimates. From current levels near $85, the consensus implies approximately 13% upside to the mean target. Taking both signals together, our DCF analysis and Wall Street consensus, a reasonable fair value range in our view sits between $78 and $90 per share. This reflects significant downside risk from current levels if the market reprices L'Oreal's growth trajectory. Market sentiment around L'Oreal leans bullish overall, driven by strong recent earnings results that surprise to the upside, though this is partially offset by broader headwinds from geopolitical tensions and rising commodity costs. The bull case rests on L'Oreal's pricing power, brand resilience, and margin stability. The bear case rests on slowing growth, stretched valuation multiples, and the company's vulnerability to consumer discretionary slowdowns during economic weakness. In our view, valuation is the primary constraint to an attractive entry point at current levels. Moving to financial strength, how solid is the foundation? L'Oreal's Piotroski F-score is 6 out of 9, indicating mixed but acceptable financial health. The F-score is a 9-point checklist that accounts for profitability, leverage, liquidity, and operational efficiency. A score of 6 suggests the company is performing better than average on roughly 2/3 of these tests, though there are some areas of concern that warrant monitoring. The Altman Z score, a model that predicts bankruptcy risk, is 5.83, which falls in the safe zone above 3.0. This indicates very low bankruptcy risk and a stable capital structure. From a credit perspective, L'Oreal's cash-to-debt ratio is 0.83, meaning the company holds roughly 83 cents in cash for every dollar of debt, a modest but adequate cushion. Interest coverage, the ratio of operating earnings to interest expense, is strong at 23.72 times, indicating the company generates earnings more than 23 times its annual interest obligations. This is a sign of financial stability and very low refinancing risk. The current ratio, which measures short-term liquidity, is 1.44, meaning current assets exceed current liabilities by 44%, a healthy level. Debt to equity stands at 0.34, showing the company uses modest leverage relative to shareholder value, which is conservative and prudent for a mature business. In aggregate, L'Oreal's balance sheet is solid, with manageable debt, strong cash generation, and low refinancing risk. Financial strength is not a constraint to this thesis. Next up, profitability. Is this business actually making money efficiently? L'Oreal's return on invested capital, or return on invested capital, is 14.24%. Return on invested capital measures how much profit the company generates for every dollar of capital deployed, shareholders' equity plus debt. At 14%, this is a strong return, well above the cost of capital for most developed market consumer companies, indicating the business creates real economic value. The gross margin, revenue minus the cost of goods sold, divided by revenue, is 74.32%, which is exceptionally high for a consumer company. This reflects the intangible value of L'Oreal's brands, allowing the company to charge premium prices relative to commodity input costs. Operating margin, which includes distribution and marketing expenses, is 20.19%. This is also robust, demonstrating that the company converts gross profit into operating profit efficiently, even after significant spending on brand support and logistics. Net margin, the bottom line, is 13.91%, indicating approximately 14 cents of profit on every dollar of sales. Free cash flow margin, operating cash flow minus capital expenditures, is 16.29%, which is very strong and suggests the company generates cash faster than it earns accounting profits. Return on equity, or ROE, is 18.52%, meaning the company generates 18.5 cents of profit per dollar of shareholder equity annually. Return on assets is 10.64%. In summary, L'Oreal demonstrates exceptional profitability and capital efficiency. The company's ability to convert revenue into cash profit is a core strength, and a primary reason the stock commands a premium multiple. Profitability is not a constraint. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 4.80% annually, which is modest for a company trading at a forward price-to-earnings ratio of 26 times. Over a longer 5-year period, revenue growth accelerates to 10.9% annually, suggesting the company faced a period of slower growth in the most recent 3 years relative to the 5-year average. This deceleration is a key concern for the current valuation. When investors pay premium multiples, they are implicitly assuming the company will grow faster than it has recently demonstrated. Book value growth over the trailing 3 years is 8.8%, indicating shareholder equity is expanding at a healthy pace driven by retained earnings, though this is not exceptional growth. The dividend yield is 1.93%, meaning the company returns roughly 2% of its market value to shareholders annually through dividends. For a mature consumer company with strong cash flow, this yield is modest, suggesting management is retaining a significant portion of earnings for reinvestment or buybacks rather than prioritizing distribution. The setup here is straightforward. A company with exceptional profitability is growing at single-digit to low double-digit rates. The market appears to be pricing in a reacceleration to higher growth, but the recent 3-year trend contradicts this expectation. Unless management demonstrates a meaningful inflection in growth rates or provides forward guidance supporting acceleration, the growth outlook remains the primary valuation risk. In our view, investors should watch closely for signs of demand improvement, market share gains, or emerging market strength in upcoming quarterly disclosures. Now let's talk smart money, what institutional capital is actually doing with this name. This is where the thesis becomes concerning. 0 top-tier gurus currently hold LRLCY, meaning the most famous and successful long-term value investors tracked by Dataroma have no position or have exited their positions. Only 0.1% of 13F institutional filers are net buyers, meaning fewer than 1 in 1,000 institutional shareholders are increasing their positions at current valuations. For context, when smart money flows turn positive, this indicator typically reaches 5 to 10% or higher, signaling conviction among the professional community. The near-zero reading on LRLCY is striking and suggests sophisticated investors are either avoiding the name or trimming exposure. Insider ownership is 0.0%, meaning management and directors own essentially no shares of their own company. This is a major red flag in our view. When insiders hold no skin in the game, investors lose an important alignment mechanism and a source of conviction. Over the last 3 months, there have been 0 insider buys and 0 insider sells, indicating no meaningful insider activity whatsoever. This inactivity, combined with 0% insider ownership, raises questions about management's confidence in current valuations and strategic direction. The smart money picture: 0 guru ownership, near-zero institutional net buying, 0 insider ownership, and 0 insider transactions, is uniformly weak. This suggests that the most disciplined capital allocators in the world are not building positions in LRLCY at current levels. When professional investors avoid a name entirely, it warrants caution, especially when that name trades at a significant premium to intrinsic value. The smart money signal is a major constraint to the investment thesis. And finally, the verdict. Let's bring it all together. On valuation, LRLCY trades at a significant premium to intrinsic value, with our DCF model suggesting 78% upside is already priced in. Financial strength is solid, with a safe balance sheet and strong interest coverage. Profitability is exceptional, with return on invested capital of 14% and net margins near 14%, demonstrating real pricing power. Growth is the constraint. 3-year revenue expansion of 4.8% is insufficient to justify current multiples, and no meaningful acceleration is evident. Smart money is absent. 0 guru ownership and near-zero institutional buying signal that professional investors are unconvinced at current prices. In our view, a fair value range for LRLCY sits between $78 and $90 per share, representing approximately 8 to 13% downside risk from current levels near $85. This is not an attractive risk-reward setup for new investors in our opinion. LRLCY is a world-class company with durable brands and exceptional profitability, but it is a world-class company trading at a price that already reflects years of flawless execution. The stock warrants caution unless valuation resets materially lower or growth reaccelerates in a convincing and sustainable manner. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on LRLCY. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.